Hello and welcome to Gold and Silver Assets. I'm Diora and it's Sunday the 28th of March 2021. Now this probably sounds like a very strange title. What on earth could I be talking about here? Well, isn't it lovely being out on a boat on the water on a warm summer's day with very calm waters like this? Of course, it's a different story when the water's surface becomes volatile. Under those circumstances, I'm very prone to losing my lunch. So yeah, I'm talking about volatility of stock prices today. Volatility of asset prices can be just as tough to deal with as seasickness. Volatility is a measure of the degree of price fluctuation, and this is a non-directional parameter. Historical volatility is the range that prices have traded over a given period in the past, and it gives us an idea of how price behaved under known market conditions. Implied volatility is the market's view of the expected trading range over a given period in the future, and this is not a static number, but one which continually changes to reflect the market's view. Now, price volatility does have its advantages. If a stock were to have zero volatility, you're not going to be able to make a profit on that since the price is static. Volatility provides us with opportunities to profit. The greater the volatility, the larger the potential profit. Volatility is also associated with faster profits as well. You also tend to learn the required lessons much more quickly with volatile stocks. There's not a lot you can learn from looking at a very slow and steady stock. And if you do any learning from that, it takes a long time. Price volatility also has disadvantages. Volatility, as I said, is non-directional, and so it works both ways. While it provides the opportunity for large profits, it also provides the risk of equally large losses. 50 to 90% losses are not unusual with volatile stocks. The risks, as I said, can be high. How can we measure volatility? A common way to state it is the standard deviation from the mean for a given time period. The width of Bollinger Bands can be used, so a wide band would indicate high volatility. And another way to look at it is the maximum drawdown. So that's the largest price drop from peak to trough over a specific time period. Beta is an alternative way of expressing volatility, but this time it's in relation to another asset or index. Today I'm going to concentrate on the Bollinger Bandwidth and maximum drawdown. So here we have a chart of gold on the monthly scale, and below I've got the Bollinger Bandwidth indicator. So let's start by looking at the volatility peaks. You can see here that the highest volatility occurred in 1980, and that actually was the very peak of the bull run up here. And you can see that the bandwidth reached just under 2 there. Now notice how all the peaks in volatility are followed by a drop in the price of gold. So that happened pretty consistently. Here the drop was actually relatively small. Now the problem with using this as an indicator is that we don't actually know how high the volatility is going to get before it turns around. And so, it's very easy retrospectively to say, oh yeah, that was a peak there, that was a peak there. But prospectively, it's actually very difficult. And so I think this is more something that will be more useful at the extremes. So for example, when the bandwidth exceeds 1, that's when it's at least worth starting to become more wary, because obviously that's only happened a couple of times historically. Let's take a look at the same thing for silver. And again, you can see that the large peaks in volatility were associated with the peaks in the silver price. And again, that was followed by, in many occasions, quite a substantial drop, although here the drop was actually pretty small. But note that we've got another imperfection in this indicator. And remember, pretty much all indicators are imperfect. So the problem with this indicator here was that you can see in 2008, we had this spike here followed by quite a large drop in the silver price. But here, there was not really any peak in volatility here. And so that signal just was completely lost there. And that drop there was actually around 60% drop. So although it's not perfect, in general, we can conclude that major peaks in volatility tend to occur at the end of bull markets in both gold and silver. So in silver, we were looking for something kind of close to or above 2 would be a real extreme, and that's only happened once. Let's move on to look at the maximum drawdowns. And this is gold on the monthly scale, and it shows the 1970s bull market. And here I've labelled all the percentage drawdowns that occurred along the way. We can see here that this is the first leg of the bull market, and the drawdowns started off relatively small here at about 5–7%ish. Then it increased to about 13%, and that's followed by 28% and 25% drawdowns. Then you had a bear market, and so of course you had a large drop of around 48% there. And then that was followed by the second leg of the secular bull market. Here, the drawdowns again were relatively low to start with, in the low teens, but then increased to the 20% kind of level. And then we saw the very, very long bear market here. The initial drop here was about 40%, 48%. In the gold bull market of the 2000s, drawdowns were in the single figures to start with, so about 9% there. And then in the kind of low teens. And then as the bull market progressed, we got into a 25% drawdown here, and that was followed by a 34% drawdown. And then, of course, the end of the bull market saw an over 40% drawdown. Now, does that sound familiar? Now, one of the things also that I want to point out is that when you look at these charts retrospectively, most people just see the big rise, and these drawdowns, most people don't even notice them, or if they do, they think, oh yeah, it's just a little correction, and then it carried on. And so they don't understand what that feels like in there and in here. And it's only when you're in it prospectively that you really do feel that pain. And so that's the value of doing things in real life prospectively. Looking back, it has its merits, but also, you know, there are things that are missing. And so one of the things that are missing is that experience of that drop. When you're in that drop, it can feel really nasty, particularly if it's something as big as 34% there. And, you know, people will have said, oh, that's it for gold when price was over here. And the thing is, you see, when you're looking at it prospectively, you don't see this big run up occurring afterwards. All you see is how much price has dropped. And so that's something to bear in mind. And you've got to expect these kinds of drawdowns, but also try and work out where you are in the bull market as well. Silver is interesting because in the 1970s bull market, you can see that the drawdowns weren't actually quite as bad as they were for gold. So in the first leg, it was about 12 and 17%. The second leg, there was only one 20% drawdown over here, and there was a 12% and a 14%. So this leg up was actually not too volatile. Of course, it was quite a different story in the 2000s. So here you can see that there were three major drawdowns: 32%, 37%, and this whopper 60%. This is really, really volatile. Why is it more volatile in this bull market than it was in the 1970s? Well, I reckon it's probably related to the paper pricing of silver, which was probably less so in the 1970s. I don't know, I wasn't around in the 1970s. Does anyone know what the paper market was like then? Anyway, in conclusion, you can see that volatility tends to increase as the bull market progresses, and it's normal to have 20 to 35% drawdowns. You have to expect that. And so how do you deal with this? Because obviously, experiencing a 35% drop in real time can be quite traumatic for some, particularly if they got in at a peak beforehand. So how do you sort that out? Well, the first thing is to understand that's what happens and anticipate it happening. Of course, you're not going to be able to know exactly when it's going to happen, but as long as you're vigilant, at least then you've got some chance of not being shaken out. And that's the thing, bull markets can shake people out, and it's not as easy to profit from them as many people think. Okay, if you do anticipate these drawdowns and you're lucky enough to know when they occur, there are some things you can do to profit from them as well. Basically, this show is some groundwork for a future show. I'm just waiting for things to get a bit more bullish before I present that. Oh, I've been wanting to present it for a few months now, actually, but yeah, the opportunity hasn't arisen yet, but it's coming. And there's also another show about how to deal with these drawdowns as well. Basically, a bull market is volatile, and it's a bit like being on a rough boat. It's not on calm waters, and you don't want to lose your lunch. Next up, the market update. Let's start with gold priced in US dollars on the daily scale. And last week we spoke about this rising wedge over here, and that although they can break out upwards, the highest probability was a downwards breakout. Well, that happened, but the good news is it didn't exactly plummet through there. We had the breakout, and then often when you get a breakout like this, it comes back to retest the underside of the wedge before moving down. So it's not necessarily over yet. I think, let's see, but further drop is possible. Let's have a closer look at this area here by moving to gold in US dollars on the 4-hourly scale. And here you can see that gold is kind of within this trading range between around 1720 and about 1750. And if we are to see further upward movement, we would need to see a close and sustained price action above the 1750 level. But a drop below 1720 is still not disastrous. If our target is based on just this trading range, then we're looking at around the 1700 level again. And beyond that, well, we'll have to wait and see. But there is some support there at 1700, as we can see over here. Of course, there is always a possibility of the drop down here to 1660, so we do have to be open to that. But that doesn't mean that we're not long-term bullish on gold. That's still within that long-term pattern and that downsloping channel that we've been talking about earlier. And that's still within that volatility range that we spoke about earlier in the show. So it's just a question of when we get this turnaround and how long it takes. It has been dragging on somewhat, hasn't it? Okay, let's move on to silver in US dollars on the daily scale. And I was trying to see what's going on with this price action. And one possibility is this descending wedge. If it is the case, that would be very bullish for silver. as you can see here, we've got 3 touches here, so that's quite a nice trend line there, and we've also got 3 touches over here. So, you know, that makes this a distinct possibility. But of course, there's nothing to stop it coming and touching again. And if it were to do that, then we're looking at $24. And again, that fits with all this support that we've got back here. But it doesn't have to do that. I've looked at wedges in other assets, and I've been tricked by this. Sometimes I've been hoping for price movement to that kind of level, and instead what's happened is it's just kind of drifted sideways and then just blown up through there before I even notice it. So especially because we've got these touches over here and here, that is a possibility as well, is that, you know, maybe we get a tiny dip here and then turn around. But I think this potentially is positive if that is the correct price action that we're looking at. That's the thing with these charts, is that they are very subjective and people can see different things with these charts. Let's move on to the gold miners, and yeah, they haven't been too bad either. We were talking about this upward sloping channel and a breakdown below that, which is what happened, and we even hit our target there of 32, which I spoke about. And interestingly, it bounced reasonably well off of that. And so now I'm wondering if we're within this down sloping channel here, in which case we could get another test of that 32 level. There is still a little unfilled gap here. It was partially filled, but, you know, it's not completely filled here. And so that bothers me. So we may get another dip down to maybe even the bottom of this channel here. And then we'll have to see, you know, what happens. We can only say that this downtrend has changed on the 4-hourly scale anyway, when we see a breach of this upper channel over here. And finally, we have the junior miners. This is the SILJ, and this has been going up and down, up and down. It's basically a sideways market at the moment. It's not trending. On the smaller time scales, again, we spoke about this channel and it broke downwards. Interestingly, it was quite an exuberant breakdown. There was a large gap over here and prices bounced up again. So as long as this lower trend line remains intact, I'm still not worried. Now you might say, well, why? I mean, that could break quite easily. Well, I think there are a few things. First of all, I think it's going to want to close that gap potentially. It's not guaranteed, but often it, you know, in the shorter time frames it does. But that's not a strong enough reason, really, is it? Let's go to the weekly scale. And so this gives us a bigger picture view of this. And here we've joined the trend, the highs here and the lows here to form this trend line. And it seems to be forming this compression. And you can see that price is bunched up against here. So in previous times, it just bounced off of it as a spike. But here it's kind of hanging around for quite some time here, which I think is positive. And that attempted break, although it got rejected very quickly, again, I think that's a positive thing as well. Now, to me, this actually looks like a bit of a flag pattern, doesn't it? So we've got this flagpole here, and then this could be the flag here. Of course, we've got these outliers. But yeah, if that is the case, that would be a bullish pattern, in which case we're looking for that breakout upwards. And last week, someone mentioned about using line charts. So, for instance, here you could use either often we use the closing price to draw these lines. And this has some validity in that it just kind of simplifies things. So you're not seeing all those wicks, and sometimes the bars can be confusing. Whereas this actually kind of clarifies things. And this really does look like a flagpole, doesn't it, with this kind of flag pattern. In which case it looks like we're coming close to a breakout. Usually they break out roughly around 60% along the pattern. So hopefully it's not going to take too long to break out. It's just difficult to know when, because again, that's not a hard and fast rule. But since it's been progressing, every week that goes by, we're more likely to see a breakout. Now, there's no guarantee of which direction this is going to break out. It just shows that this is a compressing pattern that's forming a consolidation basically, and often the moves that occur after such patterns are usually pretty strong. What we don't want to see is a strong movement downwards. Of course that's entirely possible, but I'm just sensing from various things that we're going to get an upwards breakout, but who knows? Let's see. That's it from me for this week. All the best and see you next week. Bye.